Jono, to you first on gold's next leg or the future course of that precious metal. Doesn't that ultimately say it could be in bubble territory because silver has been cast as running too hard, too fast, typically like a bubble? If gold's going to outpace it, shouldn't we be worried?
No, not at all. I just generally think that the silver market was fast and furious both ways. The gold market has been steady and it remains steady. It's interesting, that gold-silver ratio, because that gold-silver ratio got to its low when the Hunt brothers tried to corner the silver market. So trading up around about 43 to 45 still suggests that gold still has a little bit way to go. And I'm really supportive, because we're supportive of the price of gold and a breakthrough 1530, because we're starting to hear a few rumours about a new ETF in China, and I think that'll help things.
Tell us more about that, how that would work, an ETF in China.
Yeah, what happened was the Shanghai Gold Exchange sent a test case out where they allowed investors to access the global ETF markets for gold. And it was quite successful because they had one on the Hong Kong market and it was subscribed quite a lot. Now the exchange is actually looking to actually do their own, because they've seen how successful it is and how the average investor in China can get access to the gold market. Remember, the central bank really likes gold, and I think for the community to like gold as well and have access suggests, I think, that you're going to see continued demand out of China. Remember, so far this year, China has outpaced India in terms of its demand, so it's an interesting space to keep an eye on.
Mark, is it kind of like a game changer for that gold price?
Sorry, yeah, the gold market. It's I totally agree with Jonathan's comments. I think it is a very strong story. I think when you look at the appetite coming out of Asia, I think the big issue in China is that they're looking for alternative investment classes for that rising wealth. The big issue is there's been a lot of funds that are going to the housing market, which is creating a bubble type situation. It's hard to talk bubbles and gold in the same sentence to some degree too, because as the price of gold goes up, it fuels stronger demand. So it's not like there's a lot of end use behind that could be destroyed, because demand sort of picks up with the price. So you could see that upward momentum continue in the next 12 months.
And yet demand can only run so far until it becomes too expensive, Mark Pavan. Are you looking at a certain level where some of those market participants will be flushed out?
Yeah, I think this is one of the reasons why the silver market was so attractive earlier this year, was that for that very point, the gold market started just to nominally look very expensive for a lot of the small retail investors in Asia, India and China. And they thought, well, it's better to buy it at $35 an ounce rather than $1,400. Same kind of investment vehicle, sort of a hedge against sort of uncertainty. So we saw strong investment for silver in India and China, and that could return. I think I agree with Jonathan that you'll probably see silver move up with gold, but gold has been a less volatile story, and I think a lot of investors will probably prefer that.
Jonathan, just so we understand the reason why you are so bullish, what is behind the buying? Is it safe haven demand, and therefore does it somewhat offset any bullishness we've been talking about the US economy? Or is it a lot to do with hedging of bets in other parts of the world, as Mark was saying, principally down in Asia?
Yeah, Carson, look, I mean, there's a lot of good reasons why we still like the story. We've seen a correction, there's no doubt, when we saw that drop below that 1470. But when you look at it, it still remains a good story across the board, not just from a dollar perspective. Remember, the dollar firmed and gold went up, but from a hedge against concerns in sovereign wealth in Europe, which is still there. I think it's just one of those things now that people can see the ease of getting access to, and they just like it as a hedge, and that's all it is. If you look at your portfolio, and you can say, well, okay, let's have some physical gold in it somehow. And the ETF market's been a success story for now 2 to 3 years. So I think that's there, but I think more people are getting used to it because there's so much uncertainty on the political front, the economic front, inflation, all these sorts of things just still create that appetite.
Mark Pavan, Glencore, there's a link here, the world's largest commodity trader, having its debut in Hong Kong yesterday. Investors, mum and dad investors, if we can call them that, in Asia, really sat on the sidelines. They thought this was too expensive an offering. And in the same way, I'm just intrigued to know how gold still remains a play for a new type of investor, people out there who wouldn't otherwise have had it in their portfolios, the harder it runs up.
When you look at Asia, the Asian investors are a little bit, I suppose, they're new to the game to some degree. I mean, they're not as sophisticated as, say, some of the Western investors. They also have a propensity for physical assets, hard assets that they can feel and touch. Hence, the property market's been so attractive. The gold market gives them that physical access. I mean, it's very difficult for them to be acquiring sort of barrels of oil. So they can store very readily silver and gold coins and bars and so forth. So, there's a real affinity and attraction towards buying that market as a commodity, or if you like, as a commodity exposure, inflation hedge, if you wish. So, we know that there's this strong appetite. The other issue, you talk about India particularly, very strong propensity for jewellery consumption, and that's also the case in China as well. So, more so than we see in the West.
Jonathan, we know that everyone's been talking about these calls from Goldman Sachs on the oil price for the end of the year. Perhaps so, Jonathan, be careful what you wish for. Would an oil price at around 120 or 130 US dollars a barrel pose some pretty big problems for, in fact, China? Because we always talk about the impact on US gas prices and what they pay at the petrol pump, but I mean, China would really be worrying about that kind of level, wouldn't it?
Oh, absolutely, it really hurt. I mean, it was interesting that move last night, Brooke, because you go through the data, the economic data out of the US wasn't that crash hot. You look at the inventory data, and yes, there was a concern on the diesel and the heating oil side, but then when you look at the surge in gasoline and the builds continuing, you've got to try and weigh this up as to say, well, is there so much demand there at the moment? Or is it just purely that speculator looking at it? And is there always that speculator on the back of Goldman saying it's going up looking at it? So I think last night's movement was a lot to do with a little bit of dollar and a little bit of Goldman's report sort of spooking the market to say, look, I think it's going to go up here. Having said that, 95 has held very, very well. That was an area we looked at and have looked at for the last 2 weeks, I think. And because it has held, I think those shorts are also weak. So I wouldn't be surprised to see that crude will continue to have a run to the top side. It's tested the bears. It's held at 95, so I think back to 105 is certainly on the cards. As to whether we get to 120 and how that'll affect the economies will be a different story, because as we know, Asia's trying to slow down, and I think if you keep on putting these primary inputs higher, it's only going to act further of a break, so perhaps we've got a little bit further to fall if in fact that happens.
Let's switch and talk soft commodities. We're looking at the cotton price and wheat futures as well. Looking at the weather outlook, there's been wet conditions in a lot of these key growing regions. What's going to, I guess, govern the next leg up for those commodities? Will it be weather or will it be currencies?
I think it'll be both. I think generally you don't want to see grain prices continuing to firm, and that to me is the key. But at the moment there's too much uncertainty there. Not only with that, but with the world ending stocks and the potential yields that we're expected, not just from the US, but more from Russia and more from China. I think there's still a bit of an ugly picture out there. We haven't been told the full story, but let's just see as to how the yields and potential plantings come in. Remember, we're really behind the pace for soya and winter plantings this year in America, and I think that's going to affect the yields drastically. It's
been said, though, that concerns about global growth could stunt demand, even if you don't get enough product actually out of the ground because of those adverse conditions. The price action's not necessarily going to run in a straight line, is it?
Oh, look, whether it's a straight line or not, it's certainly going to appreciate, and that's going to affect our inflationary calls.
Okay. So you don't think that some of those global economic concerns may see some of those investors reassess whether they would be putting their bets on, say, a commodity like cotton?
Well, look, I think cotton in itself has had a massive run, and it's just come back to some good consolidation. I think when you look at cotton, this is still the big weather is the big weather concern. It's all around us. We just sort of see what's happening with the tornadoes in America. This is not just America, this is a global concern. And if you don't have that yields, people will pay up, and or people that have the commodity aren't going to put it on the market. So you get hit with a double whammy on that, and that only results in prices moving higher.
All right, price action tonight in the United States. First quarter GDP numbers out. We did see a market not really concerned with fundamentals in the previous session just gone because those durable goods orders were not impressive. Markets put them to one side. Will they do so with the GDP as well? If it's weak.
Yeah, I think if it's weak, they'll do that as well. I think that to me is, let's see what the GDP numbers come out. but I'm not expecting a flash number. If it is, I think you'll see that momentum will carry on into the equity markets and into the commodity markets. I think the market really in the US wants to see good news. If they see good news, they'll react to it. They react more to positive news than to negative news.
All right. We'll leave it there. Jonathan Barratt, appreciate that, as always, from Commodity Broking Services.